Right, guys, welcome to this 6 days training. And in this particular training, we'll be talking about the institutional framework, right? So this is the first part of it, right? So I promise that this is going to be brief and straight to the point, right? So most of what will be discussed here, since I actually learned from the inner circle trader, I wanted to start with this video before going into market structure and other stuff, right? So you guys can understand the basic framework of how the markets operate, all right? So when it comes to the financial market, there are basic elements of an institutional trade setup, right? So we'll be talking about the four of them, and then I'll be explaining what it looks like on Richard example, and then I'll be explaining how to use these frameworks to your advantage, all right? So these particular frameworks will be discussed in details in this particular video, and then in the subsequent lessons in this playlist, because I'll be grouping these 6 videos of this training into a particular playlist, all right, that'll be available on YouTube for easy access, right? So for easy organization, it's going to be in a single playlist, and then have fun. So now when we talk about the basic elements of an institutional trade setup, we are referring to basic things, right? We're referring to um referring to four, right? There are actually four conceptual frameworks to a tree setup, right? There are four of them, and these four frameworks are the number one, the consolidation, the expansion, the reversal, and the retracement, right? So these are the four basic things that the market operates on the institutional level, right? So the market is either consolidating or is expanding or is reversing or is retracing, right? If you open your chart on whatever market, you observe that the market is either consolidating or is expanding or is reversing or is retracing, right? So we're going to be talking about these four frameworks so that we can understand how to navigate when we see such setups. Now, before we go into the classify each and every one of them, or each of them rather, you must note that it is a consolidation before an expansion, right? So if you're looking at the operation of the market frameworks, you see a consolidation before an expansion, right? You can't see consolidation before a reversal. You can't see consolidation and then a retracement, right? You must see a consolidation before an expansion, and then after the expansion, you can now have your reversal or your retracement, right? So these are the things you must see. It's like a kind of chain, right? So you see consolidation before an expansion, and then after that, you cannot see a reversal or a retracement, right? You can't see consolidation and then a retracement, or a consolidation and then a reversal, right? So as we talk more, you will understand what I just explained, right? So now, a consolidation is a result of the accumulation of orders by smart money, and it's usually visible, it's visually depicted by a range or a box-like movement, right? This is one market I try as much as possible to stay away from, right? Because the market is accumulating orders, right? And you're not sure what direction the orders are being accumulated towards, right? It could be a buy, it could be a sell, it could be an accumulation of shorts or an accumulation of longs, right? So basically, you want to be avoiding this particular setup, right? Now, we try as much as possible to wait for an expansion away from the midpoint of the range before pushing any buttons. That means when you spot a consolidation, it's usually like in a kind of box, like I said earlier, a range or a box-like movement, and you try as much as possible to stay away from it until you see that expansion, right? You want to see the market show you the direction as maximum is willing to move price, all right? And then the next thing there is that the reference point in this particular framework is the equilibrium or midpoint of the range. That means when the range finish forming or you see consolidation, you're looking at a movement, a sharp movement away from the equilibrium or the midpoint. Right, that is what you're looking at for you to be able to take a trade or make the most out of this particular institutional framework. All right. Now let's look at live chart in the next slide. Now, this is a consolidation on GBP AUD, right? You can see how the market is in a kind of box, right? So we mark from the range high to the range low, and then we are paying attention towards the middle. We want to see price move quickly away from the midpoint, and that gives us what our point of reference, right? So we are only concerned of in the range about the midpoint, right? We are not trying to buy the high or sell the low, right? Or sorry, or we are not trying to do breakouts, breakout and retest, right? We're not trying to sell the support or sell the resistance. We're only waiting for the range to be violated and traded quickly away from, and then we mark that point what for further what trades. Right. So now this is all what we're looking at for only consolidation, right? The next thing we usually find is an expansion. Expansion is when the market moves quickly away from a consolidation, and that is an indication that smart money is willing to do what? Move price, right? So you usually see an explosive movement to a particular direction. It usually occurs just before, after a consolidation, and it's an indication that the market trend is about to begin as smart money has shown their hands. That means when the market is done accumulating orders, then it moves quickly. Showing that smart money is willing to do is move price. That means they're kind of hedging or keeping price in a particular point, right? Most times, smart money makes the market to consolidate for the retail traders to start having speculation, for them to start getting involved, right? Because the retail-minded folks are always thinking that they must be in a trade at every given time, right? So smart money will deliberately accumulate orders while keeping the market still, right? Waiting for um you to get involved, waiting to trip you in, and then you move price explosively, all right? So now, the institutional reference point in this is the order block created just before the expansion, right? We'll see the live examples as we continue. Now, the same example, we can see that the market was consolidating, right? And then you can see the sharp movement away. Remember that we are looking at what? The equilibrium, and then the order block created at the equilibrium. So we can see that this three candles with the order block are marking from the open to the low, right? And then what do we have there? We have that market traded away from it, and then the markets came back, kind of wicked down a bit. But look at the bodies of the candle, it respected it, and the market after this, you can see what they buy away from what that particular reference point, right? So now this is how we trade an expansion, right? We want to see the market consolidate, give us another block just at the equilibrium of the consolidation, and then we look forward our entries, right? And vice versa for a sell, right? Now, a retracement is seen just after the expansion to a particular direction. That means when the market has established that it's willing to go bullish or bearish, we want to see the market do what? Return, right? So let's see. So it occurs when market trades back to the created range by the expansion. It shows that the price wants to fill the inefficiencies for what? Fair value. That means the market has finally expanded, right? It wants to come back to do what? Filling the inefficiencies created by the expansion. All right. And the reference point for this is the fair value gap or the liquidity void created by what? The expansion. So let's look at the live chart example on the next slide. So look at this. The market has was kind of consolidating around there. You can see this quick expansion away from this kind of range, and then look at what we have here. We have what a retracement towards an imbalance, right? All right, so we're looking at either an imbalance or a void, right? A void is usually when you see big candles just in one direction. So you're looking at the market coming back to fill in this void and then continue moving what the overall direction, right? So when it comes to retracement, the 2 points you're looking at are what the liquidity void and the fair value gaps. Those are the points you're looking at for your trade setup, right? So now this is another example. You saw the market trade away impulsively, leaving behind what a fair value gap, the distance between this low and this high, and the market did what came back to that fair value gap, and then what I finally fell off the face of the earth, right? So you can see how these things pan out, right? You can see that there was actually consolidation around the market traded away quickly, made an order block here, came back, traded away. You can see this imbalance, and the market was came back to fill it, and then was finally what fell off the face of the earth. This is what basically a retracement looks like. So when you're trading retracements, your point of interest are the imbalances and inefficiencies created by what the explosive swing. All right. Now let's talk about the reversal. The reversal occurs when price moves opposite of the direction it has taken after taking out what a liquidity pool. This is referred to as what a stop run, right? So It signifies that smart money has paired the orders with willing participants at a particular institutional reference point in the marketplace. So smart money is looking to pay their buy with sells and sell with buy, right? So what do I mean? The institutional reference point in this is the liquidity pool created at equal highs or lows and old highs or lows, right? So you know, the retail minded folks are usually seeing double tops or double bottoms or quote unquote equal highs and equal lows as was resistance and support, right? So they're looking towards get involved at resistance or double top or double or resistance or support, and then these are the places where smart money is doing what they pair their orders with willing participants. That means you're willing to go short at an equal high, and smart money is willing to do what to pair their longs with your shorts, right? So that's what basically where the smart money takes price to, right, and then reverse price. So when they take you out, then they now reverse price in what the overall direction, right? So this is a crude example. You can see how the market was bullish, and then you can see the market stood around there, giving us a kind of indication the market wants to do or wants to reject from here. You can see a kind of pin bar. You can see a kind of engulfing candle. And what happened? The market came back, they smashed right through this liquidity pool, and then you can see what a reversal. Right, so this is basically what a reversal looks like. Once the market smashed through the liquidity pool, either an old high and old low, equal high, equal low, and then what reverse to the downside or vice versa the upside, right? So this is another example. You can see the market was, going downward. What happened there? The market created a kind of equal kind of resistance here or support. What happened? Market slammed through it, and then what happened? Market reversed, and then it went up for this higher liquidity pool, right? So the market took out the liquidity pool, and then where did it go? For the liquidity pool just what above. You can see this equal highs there, this relative equal highs there, and that's what the market went for. So the market is drawn to this kind of area. So what do you do with this information? You want to look for what the reversals at areas where the market has doing what show willingness to do what take our liquidity pools and then reverse price to the opposite direction, right? So we'll be talking more about this as we continue. So these frameworks are to be identified for better understanding of how you should be framing your trade setups and where to pay close attention to. So more of this will be explained as we continue in this trade, right? So I want you guys to go to your chart and look at how this things pan out, how you see the consolidation before the expansion and then the consolidation, the reversal, and all of this fun stuff, right? So this will really give you a better idea of where you should be looking at for your trade setups, right? So shout out to ICT because I learned most of these concepts from him, and I won't fit to acknowledge his work and all of that, right? So I wish to see you guys in the next episode of this particular training. All right, so see you guys in the next video. Have a wonderful day. Thank you.